Wall Street says OpenAI's IPO will create trillionaires, but the truth is far darker. It could destroy your retirement. There's a hidden flaw in their accounting, one that nobody is talking about. Their revenue hit $25 billion in 2026, and they're not done. They want a $750 billion to $1 trillion IPO. That is 30 to 40 times what they actually generate in revenue. Everyone's celebrating like it's a tech gold rush, but this isn't wealth, it's a financial time bomb that could trigger chaos across Wall Street. The OpenAI IPO valuation is the kind of number that breaks every rule for a software company. It only works if they somehow capture the entire global AI market and slash operating costs to almost nothing, which is a long shot when you look at what it actually takes to build and run these systems. Normal software businesses get valued high because they are predictable cash machines with almost no extra cost for each new customer. OpenAI, well, it's the opposite story. There are huge infrastructure bills, massive power and cooling needs, and expenses that grow alongside every user. Investors are being asked to put up enormous money betting everything lines up perfectly in the future, even though the upfront spending and ongoing cash burn are massive. It's bold, but going from today's revenue to $1 trillion? That is a huge leap, the kind that only works on paper. Scaling to that level would require everything to go perfectly, and perfection is rare in tech. Think of it this way: a normal $500,000 house in a quiet suburb sits on a solid foundation with reliable framing, maintenance you can count on, and plumbing that works. Everybody agrees on that price because the structure is proven and reliable. The lot next door, someone's trying to sell a gleaming 100-story glass skyscraper for $8 million. From a distance, it looks impressive, but close up it's all smoke and mirrors. There's no solid foundation, no steel skeleton anchored to bedrock. Every floor, every pane of glass, every person inside is resting on nothing that could possibly hold it. That is exactly what venture capital is doing with AI. It is holding the whole structure together for now. The crushing load is relentless, a ballooning cost of AI infrastructure. Unlike regular software, AI doesn't ride the zero marginal cost wave. Every single time someone types a prompt, real hardware has to spin up and burn through resources. A regular Google search or pulling a file from the cloud, it is a cheap database hit, pennies or less. Generative AI is a different beast entirely. When the model cranks out a legal brief or a high-res image, it does way more than fetching pre-existing data. It's actually building something brand new from scratch. And that is the big breakthrough. But now the question is, how well and how far can it go? It's a process that costs far more than humanity is ready for. And that money has to come from somewhere. OpenAI is bleeding cash at a pace that's hard to wrap your head around. Right now, internal numbers show they're set to lose at least $14 billion in 2026 just to keep the lights on and the models running. The latest internal revisions are pushing that figure toward $25 billion or even higher as they ramp up compute power chasing the next breakthrough. And it doesn't stop there. Annual cash burn could spike to $57 billion in 2027 alone. Add it all up, and cumulative cash burn through 2030 now sits at around $665 billion. That's over $111 billion more than they were forecasting just months ago. The reason? Infrastructure costs exploded way beyond what anyone had planned. Power, custom data centers, endless chip upgrades. Every piece costs more than expected. Every single dollar of revenue they're pulling in costs way more to generate. Growth doesn't fix this problem, it makes it worse. More users mean more prompts. More prompts mean more hardware spinning up, and that means bigger losses. It's all baked into the model. To stop the servers from going dark and give themselves 18 to 24 months of breathing room, OpenAI is counting on pulling in up to $60 billion from this IPO, not for world domination or new offices, for life support. If the cash doesn't appear, somebody has to write a check. So why would Wall Street willingly drain its own accounts to feed the machine? They know the burn numbers, they see the red ink piling up, yet the plan is still to hand over $100 billion like it's no big deal. The stock market is basically a closed plumbing system. There's only so much money actually moving around in stocks, bonds, mutual funds, pension accounts, and cash piles. The total amount doesn't magically grow just because someone wants more. Every dollar flowing into OpenAI shares comes from somewhere else. When they pull massive sums quickly, everything downstream starts to starve. The buyers who can actually write a $100 billion check aren't small-time traders or retail folks on apps. They are the giants. Sovereign wealth funds from the Middle East, government pension plans, the biggest mutual funds and endowments on the planet. They don't sit on piles of cash. Idle money loses value to inflation. Every dollar has to stay fully invested according to strict rules. To buy into the OpenAI IPO, these funds have to free up cash. They start with the assets that are the easiest to move without creating chaos, like Apple. Apple stock is super liquid, with millions of shares trading every day, so the funds sell huge blocks and the price starts sliding almost immediately. They do the same with other stocks like Tesla and Amazon. Managers rotate money out of proven e-commerce winners into the shiny new thing everyone's talking about. These aren't gentle trades. Heavy selling hits the tape, prices dip, forced rebalancing kicks in across portfolios. But that's only the first wave. The real damage comes next. Trading algorithms watch every tick, every spike in volume. When they see big blocks moving, they trigger automatic shorts to protect themselves. Market makers, the firms keeping the system flowing, sell more of the same stocks to stay neutral. Prices drop faster. Lower prices trigger stop-loss orders from regular investors who weren't even planning to sell. More selling hits the market, automated shorts pile on, panic feeds on itself. And just like that, a vicious cycle starts rolling. Solid, profitable companies, the ones that actually make money year over year and back most 401ks and pensions, get sold off just to fund the newcomer. Money is pulled out of proven winners to cover the needs of a company that is losing billions. Tech doesn't crash because earnings are weak. It crashes because the liquidity vacuum from IPO funding forces aggressive selling across the board. This is exactly why OpenAI's IPO will break the stock market. The funding mechanism itself destroys value everywhere else before the shares even start trading widely. The drain is real, and the supposed safety net that everyone's counting on, well, that is the next in the firing line. The liquidity drain is nasty. Big funds dump Apple, Tesla, Amazon to scrape together billions for OpenAI. That is gonna hurt some prices short term. But the Magnificent Seven, those are monsters. Microsoft and Nvidia alone sit on trillions in market cap, with balance sheets that look unbreakable. They have deep pockets and massive cash flows. They'll just absorb the shock, maybe even step in to backstop OpenAI if things go wrong. Big tech has saved the day before, and they'll do it again, right? Microsoft already poured billions into OpenAI and owns a huge chunk. Nvidia is tied to selling chips for exactly these kinds of AI builds. If anyone could handle a $100 billion liquidity suck without blinking, it's them. And on the surface, that makes sense, except it won't happen. Microsoft and Nvidia are not the cavalry riding in. They're chained to the same sinking boat that OpenAI is on. The connections run so deep that when one starts taking on water, the others go down too. Take Microsoft first. They're not just writing checks as a side bet, they own roughly 27% of OpenAI, a stake worth about $135 billion, but that could double down to $270 billion if OpenAI hits the trillion-dollar valuation everyone's throwing around. They locked in a 20% cut of OpenAI's revenue through at least 2032. The part that really matters? How the money actually moves. A big piece of the original $13 billion investment did not come as clean cash. It came as Azure credits. OpenAI uses those credits to pay Microsoft back for renting servers. Money leaves Microsoft's pocket, circles right back in through cloud revenue. It's a closed loop that looks genius on paper until it isn't. Starting to sweat about AI wiping out your future earnings? Don't panic, we got the real story. Make sure to like, share, and subscribe before the algorithms do it for you. If the IPO faces real scrutiny and the valuation cracks, or if cash burn forces OpenAI to slash server usage, the whole loop breaks. Microsoft loses its single biggest Azure customer almost overnight. Those custom AI data centers that Microsoft built are not plug-and-play for regular cloud storage. They're specialized for heavy AI workloads, liquid cooling, massive power draw, custom setups. Revenue will take a direct hit. About 45% of Microsoft's roughly $625 billion commercial backlog is tied to OpenAI commitments. When the earnings come out, the link isn't speculation anymore. One big renter gone, and billions in revenue are at risk. Nvidia is in the exact same trap, maybe even worse. Their data center business exploded because of frontier AI labs like OpenAI burning through insane volumes of chips. Over 80% of recent data center growth comes from this small group of customers. Nvidia's guidance assumes these massive orders will continue. By the end of 2027, they're projecting $1 trillion in cumulative data center revenue. Most of that rides on OpenAI and the other labs keeping the orders flowing. If the IPO forces a reality check and spending gets cut, those orders dry up fast. The trillion-dollar dream turns into a question mark overnight. The supposed lifeguards are drowning right alongside the guy they were supposed to save. No bailout, no absorption, just shared collapse when the cash demands hit too hard. This isn't stopping at two companies. The Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, currently make up 33 to 35% of the entire S&P 500. One out of every $3 in the average American's 401k pension plan is sitting in those 7 balance sheets. When OpenAI's cash drain creates the liquidity vacuum we mentioned earlier, the foundation starts cracking. The funds see the risk early and they start selling. That triggers passive index funds to dump shares automatically. What began as just some selling to fund an IPO turns into a full sector meltdown. Trillions in market value disappear. Not because the businesses got worse, but because forced moves tied to OpenAI's math ripple through everything. This is exactly why OpenAI's IPO will break the stock market. The safety net everyone counted on turns out to be the biggest vulnerability in the system. When it rips, it goes through the entire index. Every retirement account that seemed safe gets hit. The market structure itself starts to fail. The moment the liquidity pool exposes just how intertwined everything is. The damage spreads whether anyone wants it to or not. Going public? That's almost a death sentence. OpenAI has lived its whole life in the shadows as a private company. That was their golden ticket. They could stack up catastrophic losses and keep them buried under layers of venture capital fairy dust, press releases, and non-stop hype about owning the future of everything. Investors swallowed the story whole because it felt good. The math would work itself out eventually. Or so everyone told themselves. Losses of $14 to $25 billion for 2026, spiking to $57 billion in 2027. Cumulative cash burn now revised up to $665 billion by 2030. All of it stayed locked away. Only the inner circle saw the full picture. Everyone else got the polished version. The House of Cards valuation only stayed upright because nobody had the real books to look at. The moment they file the paperwork to go public, that protection vanishes. Strict SEC rules come into play. No more hiding behind NDAs, selective leaks, or trust us slides. Wall Street gets the unfiltered truth for the first time, and the truth is brutal. The filings will lay bare the actual ratio. AI infrastructure spending is off the charts. Power grids are being rebuilt, custom data centers with liquid cooling and massive power feeds. Chips upgraded every 18 months because the hardware burns out fast. Meanwhile, end-user profits are nowhere near close. Losses aren't a phase they're growing out of, they are structural. Each new user doesn't bring in free money. It multiplies the burn. What the market priced as a lightweight digital app gets exposed as a heavy industrial utility project with no margin of error. All of a sudden, that trillion-dollar dream is put under a microscope. Investors who bought the story on faith now have to face reality. The IPO will either be way below the hype, signaling disaster to the whole market, or it gets downsized or pulled entirely, which is even worse. Wall Street would have to admit the core equation doesn't work. Revenue growth can't outrun infrastructure costs. The private AI startup market's $1.6 trillion valuation tower would get the same reality check at once. Funds start to dump anything with AI exposure. What looked like unstoppable momentum turns into an overvalued bubble overnight. For years, private venture funding has let OpenAI play fast and loose. Adjusted metrics inflated the story. Monster expenses were buried under the vague label of R&D. They sold the dream of sky-high software-like margins. The federal government doesn't play that game. SEC rules demand real accounting, and that means every piece of hardware has to be treated like the depreciating industrial asset it actually is. This is where the financial reality hits like a freight train. Those custom GPUs powering frontier models aren't timeless infrastructure like a cell tower or an undersea cable. A top-tier AI chip stays competitive for maybe 24 to 36 months before the newer architecture makes it obsolete. Running tens of thousands or hundreds of thousands of GPUs across sprawling data centers is brutal. Filings will have no choice but to show billions in hardware write-downs each quarter. Gross margins will be deep in the red. They're losing money on the physics of compute, and that is before salaries, electricity, or anything else. OpenAI will have to disclose the real-world bottlenecks that are throttling expansion. Building a 1 gigawatt AI cluster isn't just about buying chips. It's about securing enough electricity. Upgrading a regional grid means hundreds of miles of high-voltage lines, substations, and waiting years for step-down transformers that are already backlogged. Lead times in many markets are stretching toward 48 months. No amount of cash or hype can manufacture transformers or rewrite physics. The growth model slams into a wall. They can't pull enough power fast enough to keep pace with the cash burn. Once the audited filings go public, everyone sees the truth. Negative unit economics and multi-year infrastructure bottlenecks. The algorithms flip instantly. Suddenly, the AI-adjacent ecosystem, Nvidia, Microsoft, AMD, the hyperscalers, gets re-rated. That sparks real damage to the financial system. Hedge funds and investors had been borrowing against these tech giants, piling on more positions. When the filings drop, suddenly that paper value disappears. Funds scramble to sell anything they can. Tech, industrials, consumer staples, whatever moves the fastest. The pain doesn't stop at equities. Credit markets feel it next. Corporate bond spreads widen as investors wake up to the fact that the long-promised AI productivity miracle was built on sand. Companies that loaded up on debt to chase AI integration now look overextended. If the flagship labs can't turn a profit, the downstream adopters who bet on the same tech look even riskier. The private $1.6 trillion AI valuation tower implodes. None of this happens because of some viral tweet or bad earnings call. It happens because the SEC forces transparency that private markets never require. Trillions in paper wealth evaporate not from fear, but from arithmetic that can no longer be ignored. And the fallout keeps moving. The same physical constraints are already stressing Nvidia's supply chain to the breaking point. The production lines that assemble chips are already stretched. Specialized packaging capacity is limited, and high-bandwidth memory supply is running short. Any slowdown in these areas can strand billions in promised capacity, turning the data center boom into a graveyard of half-built clusters. The cracks are forming now, deeper than most headlines admit. To see exactly how these same physical pressures are putting Nvidia's entire chip empire on the edge, and why one weak link could cascade into the next leg down, check out the follow-up, Why Nvidia's Supply Chain is About to Break the Market Even Harder. It picks up right where this leaves off.